Hey, good morning, everyone. Again, I'm here today with our good friend Keith Murphy from Essex Mortgage. Welcome, Keith. We are going to briefly just chat about what we're going to be diving into this morning, and that is that the jobs report has come out, and Keith is going to show us the effect that these different reports that come out from the government, all of their studies, how they impact the markets, the mortgage markets, and those resale markets. So I'm here at my office. My assistant and I decided to come and work in the office. So you might hear some noise behind me of a few people coming and going, but we're just gonna go ahead and proceed. Just ignore those extra sounds. So go ahead, Keith, you've got the command, and let's move into your screen share.
All right, can you see my screen there, Kelly?
Yes. Yes.
All right, so first let's just open this up to what drives mortgage rates up and down, what drives the stock market up and down, and it's basically the same forces, but they're working against each other. So good news, optimism, bright outlook, increase in earnings, increase in profitability means that your basket of stocks in your retirement account are probably going to go up as investors are looking to purchase companies and stocks like Apple, Home Depot, Costco. They're looking to buy those companies when they think that their future earnings look better than they are today. Right. Conversely, when there's negative news, maybe unemployment spikes or economic slowdowns like we've been experiencing with COVID, that causes the stock market to go down because investors are afraid that those earnings may not be as bright and rosy as they thought they would be. So it's this inverse relationship. I kind of boil it down to greed versus fear. So if you have a bunch of money that you want to invest, if you're feeling bright and optimistic, you're probably going to be a little greedy and want to put it in stuff that's a little more risky, like a share of Apple stock, versus if you think things are not so bright and you're a little worried, you're probably going to put it somewhere safe, like treasury bonds, savings bonds, mortgage bonds. And so let's get into what's going on. Through, mid-March until today, there's been a lot of dark clouds hanging over the future of the job market and the economy itself, with everybody having to stay at home and, upwards of 20% of the workforce on furlough or laid off. Tough times. But it seems as though this morning we've turned a major corner. And I do think this is a very positive day for all of us, not just with regards to the stock market or interest rates. But as you can see here, this morning, the US government reported that 2.5 million jobs were created and added in May, when the market, including the government census numbers, they were expecting an 8.3 million negative number. So not only did we not go in the negative, we went up by 2.5 million. That's a spread of over 10 million from what the analysts were thinking. And as a result, the stock market's on a tear. I'll just switch real quick here. Sorry, my internet seems to be a little slow here.
That's okay.
You can see this little box right here.
Right.
As we speak live, the stock market's up 3.5% or 933 points. And it's all due to, hey, guess what? Things aren't as bad economically as we thought. People are getting back to work. People are getting out. Businesses are opening up. So this is a good thing for everyone. But there is a cause and effect. So let's switch back to the other screen, and I'll show you that when the stock market goes up, see if I can get this thing to go away. When the stock market goes up and fear subsides and greed kicks in, these holdings like treasury bonds and mortgage bonds start getting sold off. People want to liquidate their positions and get into the Apple stock that might double in the next 12 months. And this is what we're seeing from last Friday. That's where this little arrow is this is the 30-year Fannie Mae coupon. And you can see it was up here. Sorry, these little pop-ups are making it hard for me to explain, but last Friday, Monday, Tuesday, yesterday, Thursday, today,
So that's investors selling off those, wanting to sell off those securities.
Correct. So what I'm recommending for anybody who's watching and listening is to be mindful of this. We are sitting on historical low interest rates for mortgages. So whether you're refinancing a home or been thinking about purchasing a home, I think the news headlines are evidence that most likely these rates are going to be going up. We probably overshot the moon a little bit and we went uber low, maybe lower than we should have. And I have a feeling that there's a chance that the market could rebound in a V-shaped way and we could see interest rates on home loans go back to where they were in December, January, and February, right before the COVID news hit. You know, a good interest rate was 4%, 4.25%. A year ago, Christmas, a good interest rate was 4.75. So when you could lock something in the low threes still today, even with this sell-off, I think people should just take note of that and look at their financial picture. And if they've been thinking of refinancing, now's the time to get that done. And if you're thinking of buying a home, it might be wisdom to consider doing that sooner versus later as well. And the reason I say that, Kelly, is I think a lot of times, a lot of people focus on the price of the homes and not necessarily the actual cost, right? So I'm gonna just bring this little image up here.
And I'll just jump in here and say that during my, 15 years in banking and helping people grow their businesses, underwriting their loans, and I just always would tell them, look, the cheaper you can borrow money, the less it's going to cost you in the long run.
Right.
So I know that's going to be true, particularly on these 30-year mortgages.
So you want me to jump to this chart here? Mm-hmm. This is just a graph, and I think it, is worth looking at for a second. Back in 1972 through current, this is just a chart of what the average 30-year fixed rate mortgage has been. And, you could see back in the early 80s, late 70s, we were up over 15%. And ever since this peak, decade over decade, the mortgage rates have been coming down. But right now we're at historical low levels that we haven't seen before, in these low threes on the 30-year fixed and in the twos on a 15-year fixed. But the point I want to make here is, there's an opportunity here when you're hitting these kind of lows. And so I like to correlate it to the price of the home versus the cost of the home are two different things. And I think a lot of home buyers tend to, I mean, we're all consumers, so we're always looking at the price of an item or cost of goods sold. And sometimes people look at those house prices and think that it might be, hitting an all-time high. Maybe it would be wise to wait for prices to come down. And mathematically speaking, unless you're paying cash, that's not a good move. And so in this example, I'm just showing what a $500,000 loan over 30 years at 3%, fully indexed and amortized, the monthly principal and interest. This isn't your taxes or insurance.
Right.
Is $2,108, and over the course of 30 years, that would be the interest that you would pay, $258,000 and change. Even if they go back to where they were, the same loan amount at 4%, the payment's going to be higher, obviously higher rate, but the additional interest cost is $100,000. And I won't go through each line item, but you can see that, waiting for prices to come down, which I don't think they will with rising rents and the economy rebounding here. It makes more sense to purchase now at the low rate versus waiting for the prices to change, if they even will, and financing it at a higher rate. You won't come out ahead, financially speaking, even if it sounds like you would on the front end. On the back end, the math would work against you.
Yeah, in our local market, and I know up in Orange County where you are, I have a lot of agent colleagues, and we're just not seeing, we're seeing the prices going up. In fact, we're not seeing the prices going down. They're not stable, they're going up, and not in huge increments, but definitely from January 1st where we were, we've seen increases, and that is completely due to lack of inventory. We've got people that have jumped on these low interest rates to get out and buy, and that has been driving the market.
Yeah, I'm seeing the same thing over here. In fact, we unfortunately really strong buyer. He's active duty military member, and his wife. So great credit, no fear of job loss. He's been fully underwritten, approved, and again, very strong buyer. And he just lost out, unfortunately, last night. He was in a competitive bidding war with 25 other buyers for the same house.
Wow.
And he was willing to go a little bit over list price, but he had to draw a line in the sand, and it ended up going to somebody who was willing to pay $50,000 over list price, which was like $525 in the city of La Habra. So
wow.
You're right, this low inventory coupled with low interest rates, coupled with rising rents, it's like the perfect equation for these prices most likely won't come down. And again, if you could do it sooner versus later and lock in something in the threes while you still have the opportunity from a financial point of view, you're going to be much further ahead than if you had waited, in my opinion.
And, you know, for my money, even if I've got a little bit of issues on my credit so that I have to buy at 4%, but I'm buying at 4 rather than 5, so maybe I take a little bit of a hit on the rate because of that. That's still money well spent when you're looking at over time here, particularly in Southern California, every 10 years, property values practically double. So yes, we had a downturn in the economy back in 08, 09, but that was all because of horrible mortgages.
Yes.
And that's not the case now. So I think, you know, to me, anytime you can buy real estate for less than 5 or 6%, you're doing great.
Well, coming from someone who's a seasoned professional, as am I, and we've seen a thing or two, you're absolutely right. And I think it's a good topic real quick. It's easy to get, I'm not sure what the right adjective is here, confused about what is and what isn't a great opportunity for someone like you, Kelly, and someone like myself, who have been through, you know, 25 plus years of market fluctuations as far as interest rates are concerned, and you see things in the 3s, and then people want to wait until it gets to the 2s. You kind of want to shake them a little bit and go, gosh, you realize that you're borrowing money at the cost of inflation, so it's really free capital. And when I bought my first house, we locked in at a 12.5% fixed rate. And I remember 3-4 years after we had purchased our first home, we refinanced to like 9.5%. I remember my father congratulating me for a job well done, saying, you know, you'll be in that loan, Keith, for as long as you own the home, probably for the rest of your life, because, you know, you got below 10% on your interest. That's phenomenal, because at the time that was phenomenal.
Yes.
Now we're looking at 3% and people are thinking it's high. Kind of crazy thinking.
I know.
You know?
I want to become Cher for a minute and slap Nicolas Cage, snap out of it.
Yeah, exactly.
But we can't do that. What we can do is share the facts, which is what you've really done well here today. I just think, you know, for anybody just needing to see the numbers laid out for them, this is fantastic. And I really appreciate you putting this chart together for us and
Kelly,
explaining what impacts it.
For any of your clients that are watching, you know, if they already own a home and they want an ROI, return on investment analysis done on their current mortgage to compare like what do we have now versus what's available, what are our options, how much would we save, what would the break-even periods be to recoup our cost of refinancing, etc. If they want that, we provide that service to all of your clients at no charge. So
great, fantastic. I know that you do that, and I know I've referred a number of people to call and have that consultation with you. Sometimes it makes sense, and sometimes it doesn't. If they've you know, got a loan that's at 4%, they've been in it for 5 years, it's like, hey, the cost of doing that refinance, you might just take that money and, you know, pay a little extra on your mortgage every month, and you're better off doing that. So I know you've got some great tools to be able to do that analysis, and I appreciate that.
You betcha.
Yeah. Well, I think we'll just wrap it up, Keith, by saying thank you so much again for sharing your screen and all the great information here. And, you know, we'll be definitely able to help a lot more clients who want to purchase or refinance. And it is a great time to be able to buy a home. And I just really encourage people to, if you're thinking about it sometime in the next year or two, maybe you think have somebody analyze for you, maybe now is the time.